Welcome to another video from Creativo Solutions. You're actually watching the podcast series. The audio that you'll be listening to comes from live content recorded from live classes. I hope this content will help you learn something that will add value. If you have any comments or questions, please post them below and consider subscribing to the channel. The audio here that you'll be listening to will be covering inventory and we'll be discussing the difference between perpetual and periodic.
So if I'm looking at inventory, remember inventory is an asset that the business needs to record in the books of the business. So the measurement is looking at the recognition. I need to recognize it, I need to record it. So when we talk about recording, we're talking more about the disclosure. So recognition is the capturing of the information. So the actual transactions, I'm going to write that down. So when the transaction occurs, I'm going to have to measure the inventory at a specific amount. We know inventory is an asset, it must be recorded in our books. The measurement is looking at what amount do you record the inventory in your books. So the accounting rules state that we can include the cost price and any other costs associated with buying the stock or getting the stock to the business in order for it to be sold. What happens if you upgrade the inventory you've bought? So let's assume you're buying bottled, let's say, water that's bottled, okay, bottled water, but with no label. And now you create your own nice fancy label and you just put the label on that bottled water before you sell it. Would you include the cost of the label as part of the product?
Yes.
Yes, because you've improved the product. So important. Any cost, it doesn't have to be transport, it can be changing the product, making it better. It must be included as part of the cost price. And that's more detailed. So just a side note here, more detailed cost accounting or management accounting. That's another word to describe it. Okay, we know management accounting is detail. Okay, we saw that earlier in one of the other modules, okay, where we spoke about the difference between financial accounting versus management accounting. All I need to remember here is costing is a more complicated area. Okay, it's a little bit beyond the scope of what we're currently looking at. Right now, we're just focusing on how do I measure it. So measurement is key in terms of cost price plus any other costs. So if I buy the good, I'm going to include that in the cost price. If I upgrade or make the good better before I sell it, I'll include the costs. If I transport it, deliver it, pay taxes on it, whatever the case is, I'm going to include those costs as well. Because those costs need to be recovered and you would be allowed to recognize that transaction at the full amount, okay, meaning all the costs that were associated with buying the stock. Here's another consideration. If I have a discount, do you think I'll include that?
Yes.
Why do you say yes?
Because no, but last time, I remember last time you said because it's more this is what it could have cost you and it needs to be put down as much as it's a discount, but that's what you've saved. So
correct, you're right. Okay, so do you agree? What is a discount?
It's your savings. So
it's a reduction in selling price. Okay, so what did we say we're going to record inventory at? The cost price. Remember, perspective is everything. Okay, because if you're looking at perspective, the business that you're buying from, their selling price is your cost price. Do you agree? Okay, so they're going to be measuring inventory at a different amount than what you're going to be measuring it at. Okay, because when you buy the stock, that becomes your cost price. Do you agree? So if you're buying stock and it's discounted, is that a benefit? Yes. What is your cost price? It's the price including the discount. Okay, because that's what we were saying. We were saying the cost price is what we're recording. Okay, because the perspective is buying to sell. So if I'm buying, I consider their selling price my cost price. Do you agree? Okay, so when you buy something from any retailer, how do you view that price? It's your cost price. You add a markup and then you get the selling price. But now that's your selling price. That's someone else's cost price. Does that make sense? Okay. Reporting is looking at the disclosure, and that's the presentation. Okay, the layout, the format. Presentation, layout, format. It's how we communicate the information to our users. Okay, we know accounting is all about generating information so someone can use it to make a decision. Do you agree? Okay, so if I'm focusing on measurement, I'm looking at the internal stuff, okay, in terms of the price, how much is it, what am I going to record it at, and how am I going to manage it? Okay, because you have two different systems, perpetual and periodic. These could actually be grouped under both, okay, in terms of measurement and reporting. It's a consideration for both because it's a rule that we need to follow. It's something that we have to comply with. Okay, it's part of the international reporting standards, so you as a business have choice in terms of which system to implement. Okay, so are you going to be using perpetual or are you going to be using periodic? That's your choice. It's your business. You can do whatever you like. Remember, what does this achieve? Management of stock. Why do I want to manage stock? Why is it important to manage stock?
To compare what you sold, does it matches what you think your food says?
Okay, so why would you want to do that?
The balance.
Okay, yeah. It could be balancing, reconciliations. Maybe you might want to check your stock to make sure that there isn't theft or anything like that. Okay, you don't want to lose money, so you want to make sure you're pricing your goods appropriately. Okay, so do you agree? If you don't know what your cost price is, how are you going to price your goods? That's a very big challenge. Okay, and remember, if you're just thumb-sucking a price to sell your goods at, you might not be very competitive. Okay, you might be uncompetitive because all your other competitors are costing their items correctly before they sell it. Okay, they know exactly how much the markup is on every item they're selling. Right, that's an advantage. Okay, knowledge information to a business is a benefit. Okay, the more knowledge and information that the business can collect from the operations, the better. Okay, that's why you want all these reports. So if you're operating as a business, there's always reports that have to be drawn. Okay, you might even have to create some of those reports, right, for a manager to make a decision. Okay, that's a possibility. So the same thing applies here. Periodic or perpetual is just the way we're going to manage the goods. What's the difference? Do you guys remember?
Yes, perpetual is continuous checking.
Good. Perpetual is continuous. So if I'm looking at measurement, how would I measure inventory using the perpetual system? Do I still use cost price? Yes. So buying stock doesn't change. Do you agree? Does the selling of stock change? Yes or no? If I sell stock using perpetual, your last assessment had the perpetual inventory management system. So how is that question different to the other ones that you've done?
What is the question?
How are you going to manage or measure inventory if you're using perpetual? Does the measurement change for when you buy and sell, when you buy stock? No. Okay, if I buy stock, it's always cost price plus other costs. Doesn't matter which system. But when I sell stock, is there consideration?
Yeah.
What's the consideration?
Anything that you add on to, like you said, modified
No, that's the cost price.
Yeah.
Think about it. Perpetual. What did you always do? Didn't you do that? Didn't you calculate that? You did, didn't you? Okay, so in your assessment, you were given a business that had a perpetual system. So what column did you see in the journal? Cost of sales. Right, so perpetual, do I need to record cost of sales? Yes. Do I do that for periodic? No. So what do I do with periodic? I think we ended with that discussion last week. We spoke about a formula for what? There we go. Cost of sales. Okay, so the periodic system doesn't account for individual goods because that's not what it's achieving. Okay, the perpetual system is looking at continuously managing, monitoring, keeping track of every single item that's at the business. Doesn't matter how big or small. If it's perpetual, I want to know everything about every item in the store. Periodic, I don't really care what items I have in the store. If a few items go missing, I'm not going to worry, okay, because it's periodic. So what do? You take stock or you count your stock once a month, once a week, okay, once every few months, depending on the business's policy. Okay, how often do they do a stock take? Okay, and that's what you're focusing on. Okay, so if I'm looking at periodic, I need to count closing stock. Why do I count closing stock? To help calculate cost of sales. Okay, because what kind of business is going to be using Chapter 7, inventory? Trading business or service business? Trading business. Can the business choose between periodic or perpetual? Yes, they can. So it's still the same business. They're buying and selling goods. Trading entity. Will both businesses, whether they're using periodic or perpetual, will both have a gross profit? Yes. What is gross profit? See, this is basics. That's why the first few chapters are still important. What income? You need to be specific. We're looking at gross profit. Say that again?
Before you deduct any other...
At the end is a minus.
Gross profit. How do we calculate gross profits? Come on.
Gross
Income minus expenses is what we use to calculate any profit. So what's the income and what's the expense to get gross profit? What am I doing? Selling. Yes. So to calculate gross profit, I need the sales and the cost of sales. Will I have that for both systems? Yes. Perpetual will have it every time you sell an item. Will periodic have it? No, but you'll only have it once you've counted your stock. So let's add the formula here. What's the formula for cost of sales? Cost of sales equals what? Opening stock plus purchases minus purchases returns plus other costs minus closing stock. Okay, and remember we kept it simple. So I used an example. I'm going to use another example. Okay, let's show it here. Okay, so business starting with 100. Could be 100 units, 100,000, million, doesn't matter. Okay, it's just the amount of goods that this business has started with. Okay, remember I'm using periodic, so it's the lazy way of keeping track of stock. Okay, because when I buy stock, am I going to record it? Yes, you have to. Transactions arise, transactions must be recorded. So I will know how much I've bought. So I buy 3,000. Okay? If I'm buying 3,000 items or 3,000 Rand worth of stock, doesn't matter. Okay? I now know what I started with. I now know what I bought. Okay, I'm not going to keep track of everything I sell. That's not the purpose of the periodic system. What does the periodic system do? At year end or month end, let's use month end, stock take. And I see I have closing stock, or what I have left. I have 1,000 items Rand left. Okay, units, doesn't matter. Okay, so I started with 100 units. I bought 3,000 units. At the end of the month, I count my stock and I see I've got 1,000 left. What's the difference?
2,100.
And what is that representing?
What you saw.
Exactly. Okay, you started with something, you bought more, then you just count what you had left. Does that make sense? Okay, so I buy, I start, I count what I've got left, and then I know the difference must have been what I sold. Okay, so here the cost of sales would have been 100 plus 3,000 minus 1,000, which is 2,100, yes. What is that representing? The cost of sales, i.e. what you sold. And that's how businesses are going to calculate gross profit. Okay, large retailers, take any example you can think of. That's how they're going to calculate their gross profit. Because they're never ever going to know exactly how many items are in the store. There's just too many. And to go count every single packet of chips on the shelf is going to take a lot of time, and it's not even going to be worth it really. Okay, knowing exactly how many chip packets are on the shelf isn't going to help the business much. Okay, but knowing as a rough estimate, okay, so that's another thing to consider. Periodic isn't as accurate, yes. Okay, perpetual is very accurate because you keep track of everything. Right, that's why we spoke about car dealer. Car dealers need to use perpetual because they can't afford for a car to go missing, lost, stolen, and then only realize later when they do a stock take. That's bad. Okay, good is for them to keep track of every single item all the time throughout the operations of the business.
With
Go for it.
With the scanner, isn't the business able to know with every item that it's sold, and then when they do stock taking, they can know how many is being...
Yeah, so technology does help improve the way we manage our stock. So businesses can try implement more of a perpetual system now because we have technology. But even with technology, you're literally going to have to scan every single item because you need to count how much you have on the shelf. Again, what happens with the people walking around the store? Now, how do you go scan the items in their baskets? When you pay.
Yeah.
Okay, so they know how much you've bought, but they don't know how much stock that they have left. Okay, because some stock can go missing, some stock can get stolen, some stock can get damaged or thrown away. Okay, so it does become more complicated in terms of the way we account for the stock that we have. Okay, and that's why businesses look at gross profit margin percentage and mark up on cost. Okay, you guys have sort of seen this before when we looked at one of those examples where we had the VAT scenario. Okay, don't worry too much about this. I think it does come up later. We can discuss it then when it does. But for now, it's just something to consider. So to answer your question, okay, large businesses that are selling huge amounts of stock, we're talking like macro gain, those big warehouses, those massive buildings, okay, and they're selling those hypers, so the Checkers hypers, the Pick and Pay hypers, those big stores. Okay, those big stores, they're not going to worry about every little single item because it's just too much effort. Okay, for them, they're going to be looking at this very carefully. Gross profit markup margin, okay, and the markup percentage. Because do you agree they know how much markup they're adding to every product? Okay, what did we say gross profit was? There we go. Sales minus cost of sales. So for a business that's using the periodic system, the cost of sales will either be more or less depending on how much goods you've sold and how much goods have been stolen, damaged, etc. Okay, because let's think about this. Okay, let me use the example we spoke about. So the business started with 100. They bought 3,000. They counted how much they have left. They've got 1,000. Do you agree? Okay. Let's assume there was theft of 100. Okay, let's assume. Right, meaning how much did they actually sell?
2,000.
They only sold 2,000. They didn't sell 2,100. So is your cost of sales more or less? Your cost of sales is more because there was theft. Does that make sense? Let me repeat that. Okay. If there's theft, okay, remember, how does a periodic business work? They know how much they start with. They know how much they buy. At the end of the month, they count how much they have left. I'm going to assume that employees or customers had stolen 100 units. We don't know who stole it. You've got cameras to check for that. Okay, but that's not the focus. Okay, the focus is 100 items were stolen. So do you have 100 items sitting in your business? No. Did you sell those items? No. So when I looked at this example, 100 plus 3,000 minus the 1,000 gives you 2,100. That's how much you think you've sold. But have you? No, because the 100th theft reduced this amount, meaning I actually have less than what I'm supposed to have. Okay, and that's where you get the discrepancy between your gross profit markup and your markup. Because when you work out gross profit, sales minus cost of sales, okay, I'm going to have a smaller gross profit because of the theft. Does that make sense? Okay, because the theft is actually creating a bigger cost of sales than you actually have. Okay, right, but then you know that on every single item that I mark up, I know what the profit's going to be, right? Okay, so just a note here. Markup on cost is the margin / profit added to every unit. Okay, so the answer that I was trying to get to was those big retailers, okay? How do they pick up theft, damages, etc., wastage, and so on? It's checking. They check GPM percentage. How close is it to the markup on cost? Right. If there's a big discrepancy, that indicates lots of theft. There's a problem. Okay, and then I start going, now I'll go with the scanner and scan every single item, count every single item to see now, where's all the stock? What's happening to it? Okay, so you're not going to do that for every item. Okay, I mean a big shop like Macro, Game, Dion, Wired, all those big stores, okay, massive, hypers, okay, the hypers, those are big stores. Right, it's impossible to go keep track of every single item. Okay, so all they're going to do is look at that. That's what they're going to do.
That concludes the audio for this session. Thank you for listening. Consider subscribing to the channel, and if you like the video, hit the thumbs up button and we'll keep creating more to help you.